Hey traders, Steven Kowitzel here with tradersplan.com. It's about at the end of the close on Thursday. And just right now I'm heartbroken because I think my coffee pot just broke. So I'm riding on E right here, but we got a lot we're gonna have a good day. We're gonna have a lot to go over today. Look at the market. There's a lot going on right now, expecting or at least hoping for that Santa Claus rally. We might have some midsummer pullback, but we'll just kind of wait and see. Looking at the market right now, as always, if you've followed me for a minute, you know how I feel that it's not where it starts, it's where it finishes. So if we let's just look at the S&P 500. Started right here, and then midday is really trailing off, and we're almost at the close. So that's not what I like to see. I like to see it close strong, but I think we could see a slight pullback at least for a little bit, and then hopefully in the last couple weeks of the year, all the institutions that have underperformed, because we know most institutions do underperform, we'll try to do a little bit of window dressing. But let's start with the overall indices. Let me go to my chart right here. I'll just start there, and then I'll go through it this way. Okay. So you got the Nasdaq right here, and as you know, there's no complaint right here. It just continues to find support at the blue line at the 50-day moving average, and then pulled back and reversed yesterday, Wednesday, and then it's kind of popping, and we'll see if it closes above the 20-day EMA or not. But there's a lot of tugging and pulling right now. You can see the volume, the distribution has definitely crept in on this pullback. Now that doesn't mean anything if we've learned from this market, but a lot of times when you have that first crack, right, if we just go back a little bit, you have that first crack and then it comes back, and then it just kind of pulls back a little bit more. You have a crack right here, and this is typical of a raging bull market, right? It cracks, and then it takes out the high of that drop. But that's typically not the normal. You get this crack, and then it'll come back around, and then it'll just roll right back. Same thing right here, it reversed, and then it came back around and rolled right back. So you did have this right here, but a lot of times what might happen is it might come back and then shake everybody out and then roll back again. If we look at what's happened 3 out of the last 4 times. So I just want to put things into perspective. Now if the highs get taken out with conviction, like right here, this high got taken out with conviction, then it is what it is. But 3 out of the last 4 times, it's tried to come back and then pulled back a little bit more. So just kind of keep that in mind. S&P 500 definitely looks a little bit better, but man, this is a steep climb, and I know I keep saying that, but geez, just 2013 all over, when you were waiting to put some money to work, and that 10% pullback never happened. So definitely got some distribution on the S&P 500 in the last 5 or 6 trading days. So just kind of something to keep in mind. It is still way above that 20-day moving average. So even a pullback to the 50-day is nothing to be scared about if that happens. If we get a week of weakness, hey, that's totally okay. I have plenty of cash to put to work right now, so I'm down for that. The Russell 2000, and you can see, man, this just towering. You got the support. It found support, pulled back into this little bullhorn, and then broke out. And it's really been leading. It's really been leading ever since the middle of August. It was really underperforming just in a bad way, and then it broke out up here relative to the S&P 500. Came back, tested that relative trend line, and just continues to find support. So today it's reversing nicely as it pulls back hard to the 50-day moving average. Sometimes the harder it pulls back, I'm just a little bit cautious because it can come back right here, but then it doesn't quite make it, as we saw in the Nasdaq chart, and it kind of takes another leg back to maybe create more of a trading range than an intermediate correction. So, I've been talking about commodities for a while, and, I'm going to go back to this chart. I hadn't shown it in a couple weeks, and this chart right here is the S&P relative to commodities, and it's just been, the S&P 500 has smoked the CRB. It's not even close since 2011. And a few weeks ago, it looked like it was trying to curl over, meaning commodities were trying to take charge, and that just reversed right back up. So right now, you know, and we're going to look at gold and some metals, what happened to them. The stock market is the place to be, minus Bitcoin, I guess. But, you know, the U.S. stocks out of, you know, commodities, bonds, that is what's showing the strength. And even if you go down here, the S&P relative to the world stocks, you can see that earlier this year, the relative trend line broke, and world stocks are starting to get stronger. Now that's starting to curl up, and maybe it, you know, trading ranges it for a while, meaning world stocks and U.S. stocks are in line together, and then we'll see which way it goes. But if it cracks, and if you have this false breakout and then it just turns straight up, I think that means an above average move for the U.S. stocks versus the world stocks. And that's something that I learned from Martin Pring. He always says a false breakout or breakdown usually means an above average move the other way. So that's something that I just always try to pay attention to. We're going to look at the dollar in more details here in a second. And, you know, gold definitely broke out of this downtrend, but we are looking at a monthly chart. So these charts, you know, are not moving very quickly, but, you know, it's gold is starting to crack. So we're going to look at that in a minute. I'm not going to pay attention to the monthly chart right here because we're going to look at it from an individual standpoint. So you have the S&P 500. This is my breadth chart, and you can see right here that, you know, we have had a pullback barely a pullback in stocks. It's just a little blip in the screen. And then you can see the S&P 500 breadth, and this is the percent above the 200-day moving average. Still incredibly bullish, 78%. It's starting to curl down a little bit. And with mid caps, 75% above the 200-day moving average. So still incredibly bullish, and small caps, 68%. So anything above 60% is incredibly bullish, right? But you know, sometimes you want to pay attention to which way it's going. And if the market's going sideways and this just keeps going down, if it starts to break through the 60% levels, that's a place where typically a market correction will take hold. So we want to pay attention to that. But excuse me, I always remind people these are secondary indicators. So do not make initial trading decisions based on secondary indicators. You wait for the price action to follow. Price trumps everything, and no pun intended, but it does. So I don't make decisions off secondary indicators, but they're worth taking note. And then when a trend line breaks, then I give that trend line break more respect if the secondary indicators were already waving a yellow flag. So I want to look at seasonality for a second, and let's just go look at a seasonality chart of the S&P 500. And let's just go the last 20 years. Okay, so the percentage of months in which the S&P closes higher in the last 20 years, right, than it opens. So you can see that the last 4 months of the year are incredibly bullish, and then April has that hoorah before, you know, the sell may go away rule. But 70% of the time in the last 20 years, the S&P 500 has closed higher, okay? So that's bullish, and we need to take note of that even if we get some mid-month weakness. Typically, you get that Santa Claus rally, that window dressing. Now, with that being said, I want to compare it to the Russell 2000. Over the last 20 years. Now, this is the percentage of, in the last 20 years, the percentage of Decembers that the large caps have closed above the small caps, only 40%. What that means is typically in December, small caps lead 60% of the time, so it's a risk on. So it's just something, you know, to kind of keep in the back of my mind. And this is, again, you want to focus on the chart first, because, you know, there is, even though 70% of the time the market's up, you still do have 30%. And you don't want to just, you know, stick your flag in or stick your, you know, foot in the sand and all that good stuff. So, so this is just kind of worth noting, something to kind of keep in your back pocket, that small caps typically lead the market in December, and as it has been. So if you're looking to, you know, put some money to work, maybe an ETF, maybe a leverage ETF, maybe you consider, you know, small caps versus large caps, because 60% of the time in the last 20 years they have won. Okay, let's go to sector summary. Let's look at the last week, because, I typically like to see. So last week is really been a mixed bag for the market overall, but financials have definitely led the way. Okay, so it's worth taking note. And a couple weeks ago, it looked like financials were going to crack because it looks like the yields were going to crack. I swear the minute after I said that, the yields, just turned around and started popping higher. So if we break down the sector and we look at the industries, I wonder if we can go, let's see what's strong in the last month in financials. You really got the mortgage, you got a lot of real estate. So you got the mortgage finance sector, you got real estate, you got REITs, which one could argue that REITs are defensive. And then you have some of these REITs down here. So not everything in the sector, I mean, this just goes to show you not everything in the sector is created equal, which is why sometimes I'm not really a fan of buying just broad sector indexes or ETFs. Sometimes I like to drill down even deeper, because if you buy a broad sector ETF, you're gonna get all of this, right? And I want to focus on this. I want to focus on the top quartile. So, because I've noticed some of the real estate developments have done really well, and now you got the asset managers, which, the brokers that are going to typically do well. So it's just something worth paying attention to. Finances are all of a sudden in the last about week and a half are looking pretty strong. With that being said, I want to show you something, and this is a chart I stole off somebody else. So, actually, why did I log off that in the first place? Okay. So if we go to, let me find that. Okay. So you have the S&P 500 and this, right, since 1999, right? And then you had the breakout of the big trading range, and now we're in a roaring bull market. Well, here's something that's interesting that I didn't even realize. This is the XLF, the financial ETF relative to the S&P 500. Look at what it's done since 2009. It has really performed either in line or underperformed the S&P 500. This is a relative ratio. So when this goes sideways, it means it's performing in line with the S&P 500. And when it is going down, it means it's underperforming. When it goes up, it means it's outperforming. Look at what it's doing right now. So all of a sudden, you have, it's 2009, good Lord, it's almost 2018. So you basically have 9 to 10 years where financials have really just been under the radar, not really done anything special relative to the overall market. Look at that break. It is starting to, I wonder if I can just kind of bring that in a little bit, move this around. Look at that break. It's just starting to break out relative to the S&P 500, and that is bullish. That's definitely what you want to see. So it's just good to kind of put things into perspective. If you have extended period of times where financials aren't doing good, and then all of a sudden they start to show extreme relative strength, you want to be on board for that. And this development just happened in the last week or so, and that's where you want to be. So it's just more evidence. You want to look at everything objectively, no matter how you feel. That financials should definitely be considered as an overweight now. Regardless of what I said a couple weeks ago, I have no problem changing my mind at the drop of the hat as the minute I see something. So if we go to, now let's kind of look at gold for a second, because this definitely disappointed me, but I wouldn't do anything different. Because last week when I did enter a gold trade, this was curling up, meaning GLD right here in this window. It was curling up. It was finding support at this, head and shoulders breakout. Everything looked right. You had the gold miners in this window that was breaking out of this downtrend and curling up. So that looked bullish. The dollar was in its downtrend. The evidence was there, and the trade just didn't work out. And I've probably said this before, but I think it's Eddie Sudoka from the, one of the great, what is the name of that book? The Market Wizards books. I mean, he's like, if you don't like getting whipsawed, then don't trade. And that's just, sometimes that's a part of it. I look at this trade and I don't think there's anything I wouldn't have done anything different. It just, the breakout didn't work, and that's just part of it. And now you can see the relative ratio of the miners versus the GLD is kind of getting weaker too. So, you know, we're just going to have to, with commodities, and we're going to look at oil second, really got hit in the last week or so, and it took a step back. So that means you need to immediately reevaluate, you know, your thought process. If you were bullish on commodities and you see oil breaking trend lines, which we're going to look at a second, you see gold breakouts not working, and then the dollar curling up, and then the U.S. stocks starting to outperform world stocks again, you need to get off the commodity train pretty quickly and hop back on the U.S. stock train. And that's just, I mean, that's just how it is. So if we look at, let's just look at the dollar for a second. Let me create a chart real quick. Let me get all these moving averages off. Just create something clean for you. Let me just create a simple line chart. So thick line, let's go to 3 years out. Okay. Okay, so you have, let me kind of annotate this. All right, so the dollar, it broke out of, I mean, it completely broke down, right? You can say when the dollar, you can call this, you know, a trend line. It broke down. It went into this downtrend right here. Then you have horizontal support across here. So it came out. It did. I could probably draw that lower. Actually, let me undo that. Let me draw that a little bit lower, right around the 24 area, because you can see that's important, because we can find it right here and right here. So then you have it come down and it breaks this level from mid-2016. So you're thinking, oh, okay, you know, now commodities are going to go up. But then it comes back. So counter trend rally, and it comes back. Now it's retesting this and looking like it's trying to take another leg back up. So if the dollar, obviously it can do a couple things, right? It can roll back over and crack through this. Or it can, you know, kind of consolidate a little bit, go into a training range and go back up. Either way, you know, it's really at an inflection point. And I always say that about the dollar. I think the dollar leads most markets, based on an intermarket basis. So if you just look at everything and you say, okay, if the false breakout or false breakdown and above average move the other way holds true, then that should mean higher prices for the dollar, and everything else should falter. Or it could just enter one massive trading range, which, I mean, really, it pretty much has been in since 2015. Just one really, really large trading range. So again, I'm always keeping my eye on the dollar, because that really helps move other markets. If we go to, let's look at oil for a second. So let's go to the XOP, because I like this chart. Okay, so last week I also said that, you know, oil, West Texas Intermediate crude, it's made a pretty big move from 43 to 59. It's just steady rising in a channel. I wouldn't be surprised if it broke a trend line and just went into a more deeper consolidation or sideways pattern for a while, because it's entitled to a breather. And that's exactly what it did this week. It broke this trend line and is pulling back a little bit. So oil's pulling back, and we're looking at XOP. So we're looking at the oil and gas exploration ETF. One thing I noticed about this chart, and I said this a couple weeks ago, like, it just came down really hard. Like, you get these waterfalls, and it found support at the Golden Cross, and then it tried to break out, and then it came down hard again. So I think these stocks have a little bit of work to do. I think they need to work themselves out, maybe through a consolidation or maybe through a shakeout. But this initial waterfall scared me, which is why I didn't take this trade. And, you know, depending on, maybe it would have worked a little bit, made a little bit of money, but it definitely didn't break through this, and now it's coming down hard again. So, you know, oil is based on this trend line break and the way the stocks are acting, it just seems like it's entitled to a breather, maybe a longer pause. And this XOP ETF relative to the price of oil is just, I mean, if you go all the way back, it's underperforming. It tried to break out relative to the price of oil and then rolled back over. So if we can see it curl around, you know, maybe spend some time under here for the month of December, then curl back up, I think that's incredibly bullish because you want the oil stocks to outperform the price of oil, just like you want the mining stocks to outperform the price of the metal. That is a bullish environment, and that's when you want to be on board. So this is something I'm watching, and I'm hoping this curls up, but I think we need a little bit more consolidation before that happens. Where are you? Uranium. Probably something you want to pay attention to. I first put it in front of you if someone else didn't. Right around here when it broke out, it pulled back. We entered a trade in this, made money on this uptrend, and I was hoping for a deeper pullback, and that just didn't happen. You can see it was up like 12% on Monday. But, you know, if you really play the trend line, and this is a volatile one, don't get me wrong, but, you know, if you play the trend line and it is a steep one, you know, maybe it pulls down to here and you see if you want to take a trade. But I might see if it kind of pulls back a little bit deeper. I don't, that's a pretty steep trend line for me. Okay, so, you know, I really just want to look at some stocks right now. I'm going to drag my Market Smith over. Before I look at some stocks, I just kind of want to do a quick mini lesson right here. Let's look at this stock for a second. Okay, so best ads, and this was a trade I took that didn't work out, as not all of them do. But let's just look at this for a minute. You have, you know, it broke out, right, and then it rolled back over and it undercut, right? So there's your shakeout, there's your double bottom. Sometimes, so now one could argue that it's in this trading range right here. Okay, sometimes I will buy before the breakout, right? I don't mind buying right here if I see above average accumulation stepping in right here. So it really would need to step in right here before it tried to break out. And you can see it tried to one day. My point is that sometimes if you're going to buy it before the breakout, that I need to see some volume coming in, because that extra accumulation on the right side, that is going to give me more confidence that it's going to bust through. I decided against it because decided against trading the right side of this double bottom because I just didn't see any volume on the right side, and then it got close to the 12 where it found resistance earlier, and then just completely rolled over to $9 and just took these way out. So it's just kind of a mini lesson. If you're going to buy pre-breakout, if you're looking at the right side of the consolidation, maybe just make sure that the volume is there. Let me take a sip. So this Candy Technologies, boy, this is I mean, it's a wild one, but if you really look at it, you know, it had a massive move from 3 to 9. And now it's got to digest that. It has to. It's not all stocks can go forever, but man, that's creating something that's kind of compelling if you look at it. You know, it's either going to break out one way or the other. It's going to break out this way or it's going to break out this way. No matter which way it goes, I would respect it. If it starts to break down, I wouldn't hop in. If it starts to break out, I'd probably consider it. But you know, if it breaks out, it could pop very quickly. But I mean, it's just when you look at the move, a triple, and then you got a consolidation, and then if you got a continuation, it's just right now, even though yes, it did retrace, it looks like it only retraced not even 50% of this move, maybe 40% of this move. So even though that's a volatile retracement, that's still a reasonable Fibonacci retracement. And now if it breaks out of this downtrend, there could be some good gains to come. Here's kind of another lesson, this Byline Bait Corp, right? It was just a bank and it broke out, and you could say it broke out of this pivot right here. But again, I don't like to buy something that moves like straight up like this. I don't like to buy like that because this 20-day moving average, this green line is curling up under this pivot. Let me actually get rid of these lines. So this 20-day moving average is curling up under this pivot right here. So where I would want, I'd want this to move up, this to come down, give it a little kiss. There's my entry right there. I want to buy the moving average under the pivot when it pulls back, because that's what happens a lot of times. AMLP. I showed you this last week because the ETF, it performed a weekly upside reversal, right? The volume was in there. Something that's looking interesting because you had that pop on Monday, right? Which the rules are by, and now it's kind of pulling back into the middle of this. Now it's trying to retake that 20-day moving average. So, you know, if you do like dividend paying ETFs, this is pretty good risk reward in my opinion, based on the 8% dividend. The pop, there's obviously some volume coming in. If you wanted to be more conservative, you could wait on this breakout. But again, I think that's something that's looking interesting. This has been on my watch list for a while, and I bought another restaurant stock instead, which that's up pretty good too. But you have a lot of times when these stocks come out of an IPO, right? Everybody loves it. So it goes from what? It went from IPO at 20 and it went to 100. Okay, somebody must have loved it a lot because it went up 5 times in a couple months. Actually, no, that was a couple years. Okay, no, it was a couple months. Okay, so then it just gets slaughtered from 100 all the way down to 30, and then it is in a trading range for over a year and a half. Now it's breaking out of this first stage consolidation, and there is accumulation to match it. Now, this restaurant stock is overbought. This isn't where you want to enter in it, but if it consolidates above the pivot or pulls back, you know, somewhere in this area, because the 50-day moving line is going to catch up to it, I think that's where you want to be on board as it gets closer to the 50-day, because typically when you see volume like this, it'll probably ride that 10-week moving average or the 50-day up. Beat was something a couple weeks ago we all made money on. At least I hope you did, because I did. The weekly upside reversal happened, and we were here. Let's just show that real quick. The weekly upside reversal happened right here, and I bought at the open on the following Monday. I held it for 2 weeks, and then one day it just gapped up. Okay, but now the gap is filled with above average volume, kind of reversed to retake this 20-day moving average, and it's moving. So, you know, if you just look at a couple things, you look at the weekly upside reversal, which happened, right? I've already taken profits on that. You look at the breakout of the downtrend, that's happened. You look at the gap fill, that's happening. It's trying to retake the 20-day moving average. I mean, you know, the one could, I'm keeping my eye on this. I'd kind of like it to go sideways for a little bit. Sometimes I like them to digest gains, but I'm have this open for consideration for another trade. So I hope this stuff was helpful. Let me know if you have any questions. If you have not taken a trial yet, or you have never tried the Trader's Plan service, if you just want to take a trial, you can click on the email, take a trial, come join us. You can see what stocks we're in right now. I would recommend doing that. Have a great weekend.